go to chapter 4, limited companies and multinationals. So getting started. Please read the case study for me.
For ex-Google employees, set up Qubit in 2010. Its technology helps retailers get the best out of their websites. For example, if its tools track what people look at on web pages and why they leave the website. Some of its high-profile customers include Topshop, Emirates, and Thomas Cook. Qubit is led by one of the people who originally formed the business, Graham Cook, and has offices in the USA and Europe. It has raised over 50 million euros from share sales since it was set up, and some of its shareholders include Goldman Sachs and venture capitalists.
Sapphire Ventures and Axel Ventures. In 2016, Qubit employed over 200 people. Now, we have the second case study immediately. Hyundai Limited. Please read.
Hyundai is a huge South Korean motor corporation. It is led by Chairman
Mong Chun
and has a team of 8 senior
directors.
The company is listed on the London Stock Exchange and is owned by shareholders. In 2014, it has a 10.5% share in the global motor car market and has factories in USA, China, Russia, Turkey,
Czech Republic, yeah.
Brazil, and India. In addition to those in South Korea, Hyundai's sales revenue for the period 2011-2015 is shown in the figure.
So we have the figure here. So that is not where we are going yet. Now let's go to the question. Here they said, the first one, they said, who owns limited companies? So
shareholders.
What?
Shareholders.
Shareholders, thank you. So the shareholders are those who own limited companies. But look at what I wrote here. I said, shareholders own limited companies. For example, Qubit. For Qubit, I wrote Qubit case study. It is likely that they said, when you look at the Qubit case study, they said 4 ex-Google employees set up Qubit in 2010. So that means it is likely that Qubit Digital Limited is owned by those 4 ex-Google employees. Is it clear? So that means they are the shareholders. So we go down this. Okay, then I wrote also information in the case study say that some of the Qubit shareholders include Goodam Search and venture capitalists, Sapphire Ventures and Axel Ventures. When we talk about venture capitalists are specialist investors that provides money for businesses. So what they do is they make finance available for businesses, especially new businesses. That's what we call venture capitalists. They make money available for businesses. So the second question now, they said, who runs limited companies? Use examples from the case studies. So here I wrote, limited companies are run by a board of directors headed by a chairperson. A team of 8 senior directors led by Chairman Monko Sean runs on day. Yes or no? They said it is led by a chairman, Monko Sean, and a team of 8 senior directors. So these are the people that run on day. There. For Qubit, it is likely to be run by the original founders. That means the 4 ex-Google workers, employees. And the third question here, they said, comment on the size of limited companies. That means how big are limited companies? Are you with me, please? I mean, they said we should comment on the size of limited companies, such as those above, like Qubit and Monday. So they only want us to talk about how big limited companies are. So here I wrote, according to the case study, it shows that limited companies are significantly bigger than sole traders and partnerships. For example, Qubit employs 200 people. Yes or no? So it means that limited companies employ large numbers of employees than sole traders or partnership, which they might not employ more than 10 people. Is it clear? Do you have any question up to now? So that is just a preamble of a limited companies. So now let's go down to the topic itself. So limited companies. So for limited companies, here it said limited companies are incorporated. This means that they have a separate legal identity from their owners. They can own resources from contracts, employ people, sue and be sued. And we have other main features. So what they are saying is this. Are you with me, please? When we talk about limited companies, these are companies that have a separate legal identity from their owners. So that means the company itself can sue other parties, or other parties can sue the company. Do you get that? So for limited companies, they said, we call them incorporation because they have a separate legal identity from the owners. So it means that whatever happens to the business, it has to be separate or separated from the personal issues of the owners of the business. And personal issues of the owners of the business must not affect the business. That is what an incorporation is. So here they said the features of limited companies are as follows. The first one, the owners have limited liability. So it means that if the business has debts, the owners can only lose the money they originally invested. So whatever happens to that business in terms of debts, the owners do not lose their personal wealth into it.
What is limited liability?
Limited liability, that it means that the debts of the business, whatever the business owes, does not affect the owners of the business. So if the business is owing some people or some other businesses and it cannot pay back, the owners of the business would not have to pay it through their own personal wealth. Do you get it? What I'm saying is this. The business is separated from the owners, right? So if the business, for example, if business A, that's a limited company, takes money from you and the business is unable to pay back, so whatever happens, you won't get the money from the owners of the business. It is the business that is owing you, not the owners. Do you get it now? No yet. Okay. We call this limited liability because the debts, whatever the business is owing to other people, does not affect the personal wealth of the owners. So if you are having a business, now if you have, let's say this is our business. It's our business, it's a limited company. It's not yours, it's not mine, it's our business. So whatever happens to that business, what we can only lose is the investment that we put into the business. We won't lose our personal car if we have to pay debts. Unlike sole trader and partnership, that they might lose their personal wealth if the business is owing. Do you get limited liability now? So it means that you would not lose your personal belongings, your personal assets to the business in case of debts. Yeah, whatever you have, your own personal things, you won't lose it because of the business. That is what limited liability means.
You just lose
the investment. That means the money you put into the business, you might lose that. Aside that, whatever happens to the business stays with the business. Is it clear? Second one, the business raised capital by selling shares. So that means the second one here, I said the business raises capital by selling shares. So it means each shareholder owns a number of these shares. So the owners are those that invested in the shares. So the second feature of a limited company is that the owners are the shareholders. Those that have invested in buying the shares are the owners of the business. Is it clear? The third one. Here it's here. The third one. The shareholders elect directors to run the company. This implies that the chairperson is accountable to the shareholders, and if the business doesn't go as planned, the directors can be voted out at the annual general meeting. So the third one is saying that as a limited company, the directors that run the company are being elected by the shareholders. And if they are not doing well, if the company is not going forward, they can be taken out of office. How do they do that? They get to do that during the AGM, the annual general meeting. That is when they can vote out directors or vote in directors. Is it clear? The third one, or the fourth one, limited companies. Here they said, limited companies, whereas sole traders and partnership pay income tax, companies pay corporation tax on profit. So here I wrote, limited companies pay corporation tax. This is the tax on profit made. Remember when we were talking about sole trader and partnership? They pay income tax. So the sole trader and the partnership, they pay taxes, they pay income tax. But for limited companies, they pay corporation tax. And what are corporation, or what's the corporation tax? A corporation tax is the tax charged on profit. So the profit you make as a business, as a company, you pay tax on it. That tax is called corporation tax. Is it clear? And the last one, to form a limited company, it is necessary to follow a legal procedure. So it's not like a sole trader or partnership that you can form within a GP. You can form within a short period of time. For you to form a limited company or for you to set up a limited company, it takes a lot of paperwork and takes a lot of documentation. And that means you have to visit or you have to, tender or make yourself available with your documents to the registrar of companies. So what do you present? What do you present as a business that wants to be incorporated to the registrar? You present the memorandum of association and the article of association. So we start with the memorandum of association. We call it MOA. So MOA, I wrote here. This document shows the relationship with shareholders and the objectives for which the company has been formed. So for your memorandum of association, here, for the memorandum of association, it's a document that states the relationship with shareholders and the reasons why the business is formed. That is what we call a memorandum of association. Then we have the article of association. For the article of association, I wrote, this is a document that specifies the regulations of the company's operation. This is how the company is run. So the first document states the relationship the business has with its shareholders and the objectives of the business. The second document, which is the article of association, the AOA, states the way the company will be run. That means the rules, the regulations of the company.
Yes.
Do you get that? So what are the details of the MOA and what are the details of the AOA? For the MOA, I wrote the name of the company. So what has to be written in the document of which we call the memorandum of association, it must entails or it must contain the name of the company, so the address of the company, the address of the registered company, 3, the objectives of the company and the nature of its activities, what the business does. It has to entail the memorandum of association, the amount of capital that can be raised, and the numbers of shares that has to be sold. All these must be written in the memorandum of association. And for the article of association, it states the rights of shareholders. When you talk about the rights of shareholders, what the company must give to the shareholders, what the company how the shareholders must be treated, it must be written or stated in the article of association. 2, procedures for appointing directors. So we're talking about ways in which the directors, the people that will run the company, will be elected. It has to be stated in the article of association. Also, the details about each director. When you talk about the details, their academic qualification, their history, their biography, their background, it has to be stated in the article of association. The third one, length of time directors should serve. before re-election. We're talking about the duration at which each directors will be there. You know, directors are elected. Are you with me, please? Directors are elected to rule or to organize or to take care of the company, but they won't be there forever. So the duration at which they have to spend has to be stated in the article of association. That means the duration of their time running the company has to be stated or stipulated in the article of association. And the last one, okay, the second to the last, timing and frequency of company meeting. The time at which they have to go for their meeting. Is it quarterly? Is it yearly? Or is it maybe once in a month? It has to be stated when they have to take off or they have their meetings. And the last one, arrangement of auditing company's account. The company is a business, it's a corporate entity. It has different operations. So how they check and balance the financial statements of the company has to be stated. Yeah. Do you understand what I'm saying here? How they need to check their financial dealings. So how do they do that? They need to have auditing. So the time or the procedures of auditing must be stated in the article of association. There's difference between the memorandum of association and the article of association. The memorandum of association will only tell you the relationship between the shareholders and the objectives of the business. For the article of association, it states how the company is being run and the details of the directors.
What does memorandum mean?
Yeah, it's a document. It's a document stating something about your company.
Because it's different between memorandum and argument.
Yeah, the memorandum, I just said, the memorandum of association is a document telling the registrar that this is the kind of business we want to do. These are the objectives of our business. These are the relationship our business has with the shareholders. That is the memorandum of association. For the article of association, this is how our company has to be ruled, has to be organized. These are the directors we have. These are their background. These are their identity. That is the article of association. Is it clear? So we go on to the features of limited companies. Are you there? Features of limited companies.
Here?
Features.
Yeah, that one.
Here, below.
This one? No.
Yeah, features of limited companies.
No, this is
This is-
private. Limited company.
Yeah, features.
Uh-uh.
So when we talk about the private limited companies, listen, limited companies could be private limited companies or public limited companies. So here we're talking about private limited companies. So what are private limited companies? Here they said, these are, okay, well, here I wrote, private limited companies. Let me just give you the meaning of a private limited company. It's a company that has its shareholders to be friends and family. These are what private limited companies are. They can't sell shares to the public. They can only sell shares between friends and family. We call them private limited companies. Is it clear? Okay, so what are the features of private limited companies? The first one is said, I wrote, their business name ends in limited or LTD. So for a private limited company, for you to know it's a private limited company, its name ends with LTD. That means, oh, Elaf Limited or ABC Limited. It shows that it was a private limited company. Two, shares can only be transferred privately. So it means, as a private limited company, you can only transfer your shares individually. Do you understand? You can't transfer the shares to the public. You can only transfer it individually. And before that is done, it needs certain different procedures. The third one, they are often family businesses owned by family members or close friends. So it is known as a private limited company because it is owned, controlled by friends and family. And the last one, the directors are mostly shareholders and are involved in running the business. So when we talk about the directors of private limited companies, these directors are the owners of the business. Are you with me? For private limited companies, the directors are still the owners of the business. So go to the advantages now. What are the advantages of private limited companies and the disadvantages of private limited companies? So we start with the advantages. The first one. Here they wrote shareholders have limited liability. Can you see it there? So they said shareholders have limited liability. I wrote shareholders have shareholders have limited liability. That means they cannot lose their personal wealth in case of death in the business. So whatever happens to the business, shareholders would not lose their personal wealth to the business as a result of that. Is it clear? 2, more capital can be raised. Here I wrote, as the number of shareholders are more than the owners of partnership. In partnership, you can only have the maximum of 20 people. So that means the amount of money that can be raised in partnership cannot exceed 20 people. But in a private limited company, the number of shares that can be sold is more. The number of shares that can be sold exceeds that of the partner. In partnership, there's no share selling. So in private limited company, the number of people that can be involved are more than those of the partnership or that of a sole trader. So it has large numbers of people that could be shareholders. As a result of that, they can raise more capital than sole trader or partnership. Is it clear? Then what are the problems? Okay, here, the last one here. Businesses continues if a shareholder dies. Remember when we talked about sole trader and partnership? In sole trader, if the owner of the business dies, the business is likely to be over. In partnership, if one of the partners die,
The other one will be responsible for that.
no, the partnership business has to dissolve. They have to end the partnership business. Yeah, it's a partnership. They have to end it immediately and start a new one. If one partner dies, the relationship ends. Do you get what I'm saying here? In partnership, if a partner dies, they have to dissolve, they have to end the partnership. They can form a new one, but as long as one person dies, one partner dies, the partnership is already done. But in a private limited company, if a shareholder dies, the business still continues because the business is separated from the owner of the business. Do you understand? The owner would only be entitled to dividends, which he or she can still get even after his demise. Do you understand? Now, go to the problems of the private limited companies. The first one. Okay, the last one, I said, has more status. The reputation is higher than those of sole trader and partnership. Having a private limited company gives you more reputation than being a sole trader or being part of a partner. Do you understand? Then we'll go to the problems of private limited companies. Number 1, financial information has to be made public. Financial information has to be made public. What does that imply? It means that you have to publish your financial statements. That means everyone can see how well you are doing as a business, and your competitors, your rivals, can measure their success regarding your own success. It's your statement of financial position and your statement of income. That means a financial statement talks about the assets, the liabilities of the company, the profit made by the company, the revenue by the company, the expenses by the company. So the financial statement has two phases. We have the statement of financial position, which talks about the assets and liabilities of the company, what you own and what you owed. And we have the statement of income, the statement of profit or loss and comprehensive income. This statement shows the profit you make as a business, the income or the revenue you make as a business, and the expenses you run as a business. So that's what our financial statement is about. So as a private limited company, you have to publish your financial statement. And in the course of doing this, it means the public, the people will see, and your competitors can also know how well we are doing. Same goes to you understanding or seeing the financial statement of your competitors. So that means it's not secret anymore. Like when it is a sole trader or partnership, that you are not obliged to show your financial statement. The second one costs money and takes time to set up. Unlike the sole trader and partnership that you can set up within a short period of time. For a private limited company, because it takes time, because you have to go through different paperwork, it might take time and it's expensive to start up. Do you understand? The third problem about private limited companies is that it takes time to transfer shares to new owners. If you are a shareholder in a private limited company, before you can transfer your shares to someone else, all other shareholders must agree to it. If they don't agree, you can't. So that means it might take time for you to convince other shareholders that you want to transfer your shares to someone else. Was it clear? The last one cannot raise huge amounts of money like public limited companies, as it cannot sell shares to the public. The last problem about a private limited company is that you cannot raise more capital like if you are a public limited company. For public limited company, they can sell shares to countless of people, to the public, not to friends and family. So that means they have the tendency of raising more capital than the private limited company. So that means as a private limited company, the amount of capital you can raise through the selling of shares is limited to that of a public limited company, which has unlimited shareholders. Is it clear? Do you have any questions about it? So that's all about private limited companies. So we have activity 1 to 2.